Hey, what's up guys? Welcome back to the channel. I hope you're all doing well. Lower interest rates, higher disposable income, and increased investor activity has caused a stir in Canada's housing market ever since the pandemic has started. So far, the Bank of Canada has kept interest rates unchanged, but in its recent meetings, it has hinted that it is likely to start raising interest rates between now and throughout 2022. We're at a point now where you've likely noticed that everything just costs more and inflation is out of control. Some experts are even calling for as many as 7 interest rate hikes, which will take us back to the interest levels we had before the pandemic. Government support measures coupled with historically low interest rates has led to higher disposable incomes, which then led to more of a demand for home mortgages. And what's really interesting to see is that during this recession, when people were losing jobs, businesses were closed, things were getting shut down, people were actually making more money. That means people on the higher end of the income spectrum actually made more money and are now better off. All this did was increase the wealth gap between those who have more and those who have less. Those that were on the lower income levels faced more disparity when it comes to job losses and losing income streams. The households that benefited from higher income levels, the households that benefited from increased savings, what did this group do? They went out and bought real estate, and lots of real estate, left, right, and center. Not just in the GT and not just in the GVA, but all across the country. In fact, Canada has the highest housing debt to disposable income amongst all G7 nations. Simply put, we're a nation that loves real estate and loves debt to buy that said real estate. What this created was those who had higher levels of disposable incomes tapped into their existing property to take out equity, to put down a new 20% down payment for a second home, for a third home, for a fourth property, and so on. Federal support programs where they were just giving out free money created more liquid incomes. And what did everybody do with more liquid incomes? They bought homes, which increased the demand for mortgages. And now the major players who are in the mortgage market are investors who have continuously increased their share of Canada's housing market ever since the pandemic started. And let's say even those investors are not successful acquiring those properties, what happens with all the bidding wars is that they'll bid a price, and the average family has no choice but to bid a higher price. So continuously people are bidding higher and higher. And now there's scenarios where you'll see a single home go on sale 3 times a year, and every time it goes on sale, people are making a couple $100,000 every time it gets flipped. Typically, Canada has seen 3 major categories of buyers. You have your first-time buyers, your repeat buyers, and then you have investors. In the last 2 years alone, investors now make a bulk of the buyers compared to the other 2 categories. But considering the state of Canada's housing market, not only is change required, but it is coming. And what do these incoming rate hikes mean for mortgages? A hike in the interest rate leads to increased borrowing costs. Typically, a rate hike means that mortgages for buyers become more expensive as you're taking on a larger portion of interest to pay off. The rest of this year and the rest of next year, interest rates are going to be on the rise. We're about to see what happens when ultra-low historic rates suddenly disappear. That means an end to cheap and easy money flowing into Canada's housing market. For those of you who are real estate investors, either earning money through flipping homes or earning rental income, you have to make sure you check off all of CRA's requirements when it comes to tax filing. Are you claiming the right deductions against your rental income? And if you're flipping homes for making profit, how is that taxed? And how do you keep track of all this? And what's the best way to keep track of all this? This tax season, take away all the worries and all the headache about dealing with the CRA and rest easy with Cloud Tax Pro. You can have your taxes filed with a pro, and it's all done online, so you don't even have to leave the comfort of your own home. Plus, you get help with every step of the way, unlimited support from real tax experts. Plus, now you can store all your documents and all your receipts with cloud receipts. And the best part, year-long tax support even after you have filed in case the CRA comes knocking. So make sure to check out the link in the description below for a worry-free, hassle-free, a headache-free tax season with Cloud Tax. The surge in demand for Canada's housing market has brought a whole new wave of in-province migration to areas that were previously overlooked. Just take a look at this chart. It shows you which areas of the country experienced the most year-over-year gains. And just to make it really obvious, the numbers you are seeing are increases that have happened in the last 1 year. So yes, what you're seeing with Bancroft, it has gone up 50% in just 1 year. How crazy is that? And just take a look at London, Milton, Oakville. They're up close to 40% in just 1 year. How insane is this? As you can see, the dynamic has really shifted. You can go to a place like North Bay and buy a 3,500 to 4,000 square foot home for about $600K or so. And in Toronto, that'll cost you like what, $3 million? But if you think about it, in a way, this kind of makes sense, but not from a pricing standpoint. The concept that Canada is more than just a GT in one corner and the GVA in the other corner really needs to hit home. We need to spread out the jobs, spread out the economics, spread out the infrastructure so we can have a better country to live in and not just be cramped into 2 core areas. If we want to substantially change the pricing of housing in Canada, both from a renter's perspective and from an owner's perspective, then we're going to have to take bolder steps that use economic levers and not just planning policy or things like that. We need more targeted action to address the supply side of the equation, but for whatever reason, we're not seeing that response from either the federal or provincial governments. Let me know in the comments, do you think the government is taking the right steps? Why or why not? And to all those that say, well, housing only goes up in one direction, it just goes up. Even with interest rate hikes, it will still continue to go up. According to BMO, the current housing market trajectory is very similar to the 1980s housing bubble. Canada's economy is nearly back to where it was before the pandemic, and in some areas, it's actually improved since the pandemic. And the expectation of housing gains is completely out of control, so much so that the head of OSFI, which is one of the largest banking regulators, has called Canadian real estate a speculative frenzy. And honestly, he wasn't really that optimistic on how it actually ends for home buyers. And this is where most real estate investors come in and say, well, when the market crashed back in 2008 in the US, nothing really happened in Canada, so I'm not too worried about what's going to happen now. But most don't realize that Toronto itself had not even recovered from the 90s crash in 2008. It's not hard to understand why the Great Recession had a minimal impact in Canada. There's just little to correct when home prices are still recovering from a prior crash. Canada's last major housing bubble was back in the late 80s / early 90s. And BMO even charted the index home price growth during that period to show how similar the growth has been. They showed how prices have moved since the start of each real estate bubble in years. Note that the late 1980s is an infamous period in Canada's housing market history. And yes, I agree, history does not repeat itself, but it sure does rhyme with itself. Average house prices ballooned close to 100% through only 4 years in 1989, meaning annual increases of 25% for 4 straight years. And the current trajectory we're on right now is actually keeping pace with that past episode. Canada's housing supply shortage is real, and everyone is raising alarm bells that what is happening right now is not normal. Unless you're actually in the business of making money through real estate, then you're golden. Think about it. In places like Toronto and Vancouver, prices are going up in 1 month more. Now people making salaries all year. How insane is this? And if you own an extra home or two, you're likely making more money from those homes than you do at work. I don't think you're selling. And even if you're thinking of cashing out and trying to move to a cheaper region, you're going to try and maximize your once-in-a-lifetime gains. When price growth slows, and the banks are expecting that to change, why sell today when you can sell for 10% more tomorrow? And when policy finally breaks this sentiment, you're going to be surprised how quickly the problem of low supply shortage goes away. Housing prices are not just overvalued, they're comically overvalued. Canadians are playing a very dangerous game right now. To hold down the size of their monthly mortgage payments as housing prices continue to go up, record number of applicants are looking for the lowest possible initial interest rates. And the problem with these loans, also known as variable loans, is that these rates will automatically start to rise as soon as the Bank of Canada starts raising their benchmark rates. You can reasonably expect rates to rise by 1% to 1.5%. And if it rises by 1.5% or more, this is going to majorly backfire on homeowners. And this would cost more than the currently offered conventional fixed rate loans. Let's summarize the elements at play here. Overstretched buyers suddenly hit with rising borrowing costs. This is how our trouble story begins. According to David Rosenberg, an economist who famously predicted the 2008 US housing crash, if the Bank of Canada does raise interest rates based on what the market is actually pricing in, this could translate housing prices dropping by at least 25%. And what's really interesting is that this 25% he believes is an underestimate, meaning the 25% would just be the start of the storm on the horizon. The concern really isn't that Canadian homeowners will be underwater on their mortgage payments, which is what triggered the mass defaults and foreclosures back in 2008 in the US. When interest rates rise, most floating rate loans in Canada allow borrowers to keep their monthly mortgage payment the same. You just pay less principal in order to make up for the higher interest portion. And as fears of a housing bubble have grown, the government did add somewhat of a layer of protection in the housing market called the stress test, ensuring borrowers have enough income to handle higher interest rate payments. I personally think the stress test doesn't really make that much of a difference because there's ways to get around it, so it doesn't really help at all. But that's a topic for another video. It's investors whose participation in the housing market has increased more than any other form of buyer. They are the ones that are most likely to sell when interest rates start to rise. As of mid-2021, investors account for nearly a fifth of all homes purchased in Canada. This is according to the most recent data available from the central bank. Investors view their properties as a source of profit, so they may have less doubts about selling compared to owner-occupiers when economics turn less favorable. Housing affordability in Canada is at the worst it has ever been in the last 31 years. The need for more supply has never been greater. Just take a look at all the frenzy of bidding wars out there. This is no longer just a concern. This is a full-blown crisis around supply and affordability. And it's unfortunate that our government consistently fails to acknowledge this fact, that our housing market has become a paradise for speculators. And what's really interesting, as of late 2020, only about 40% of investors are actually breaking even from cash flow from rental income. That means that this group is relying entirely on price appreciation in order to turn a profit. And when it comes to real estate investors, also lever up as much as possible, making them very sensitive to rate hikes. But what's really funny is that investors, average home buyers, mortgage brokers, real estate agents don't actually believe that the Bank of Canada will raise interest rates at all, because that'll just mean that the gravy train ride is over. And if you're watching this, you might be wondering, well, is it a good time to go with variable rate loans or fixed rate loans? Are variable loans always cheaper than fixed rate loans? It's true, on average, borrowers can save around 1% by choosing a variable loan compared to a fixed rate loan. And that's because fixed rate loans are based on government bonds, so they move with the financial markets. And the price you pay today for a fixed rate loan already accounts for future rate increases. Too often nowadays, people are forced to move away from their jobs in their city or live beyond their means simply to purchase a home. When communities lose part of their workforce, employers face a challenge when it comes to retention and hiring. You may actually be seeing part of this at your own workplace. Securing and maintaining a place to call a home that is affordable, whether rented or owned, is critical to one's mental health and well-being, and creates conditions for residents to connect and develop within their own communities. What we're seeing right now is putting a lot at risk. The real danger facing Canada's economy is if the millions of homeowners who have recently piled into variable rate loan mortgages all decide that they have to cut their budgets in order to make ends meet. That will have a real impact from a consumer spending point of view, which is what allows the economy to functionally run. And if consumer spending stops, that may put people more out of work. As you can see, there's a lot at stake here based on the amount of rate hikes we see and how fast they come. How dangerous of a game are we playing? How much is really at stake here? That's it for now. Thank you so much for watching. Make sure to check out all the links in the description below to support this video and future content. And I'll talk to you in the comment section.